If you talk about direct tax law, is the core subject, and core subject for the chartered accountants also. You all know that. So bound to be a difficult paper, because the income tax law is so complex that nobody can be sure about this paper particularly. But let me tell you, friend, we have 100 marks paper. 10 marks of course have been allotted to wealth tax. I'll talk about wealth tax little later, and the 90 marks are there for direct tax. Let me tell you the very first point. Out of this 90 marks, you will invariably find 15 marks paper will come from amendments. The recent amendment which was there in Finance Act 2012. I have seen over the years, whenever there is examination for the month of May, you will find minimum 15 marks, maybe sometimes little less or maybe even more than that, being asked from the recent amendment in direct taxes. And the second, 10 to 15 marks paper is from recent judicial decisions. Recent judicial decisions, where you are really afraid of how to remember those recent judicial decisions. There are so many judicial decisions, how will we manage that? I'll come to that also. So 10 marks for wealth tax, 15 marks for, no more or less, 15 marks for recent amendments, 10 to 15 marks for judicial decisions. So it works out to about 40 marks. Is that they are not covered? 60 marks are rent for the other part. So let me tell you, you should be very clear about the recent amendment which were there in the Finance Act 2012. And very important point, very, very important, I want to tell you, please always refer to RTP of the Institute of Chartered Accountant of India. The RTP is already on the website. Kindly, if you have not downloaded that RTP, kindly download that RTP. This does not contain amendments, but this contains practical illustration, practical problems relating to the amendments. All practical problems relating to the recent decisions are given in RTP. A wonderful piece of preparation which the ICA provides to you. And secondly, ICA provides in your student portal, you must have seen BOS, Board of Studies Knowledge Portal, recent judicial decisions, and there is about 90 pages given in that recent judicial decision, which consist of cases on direct tax and cases on indirect tax. Don't think they are many in number. Don't think they are many in number. You will say, how will we remember all those cases? I'll tell you, but wait, you have to read, please, you have to read recent judicial decision, and I'm assuring you, minimum 2 recent judicial decisions will definitely come from that collection of the recent judicial decision done by the effort of the ICAI. Let me tell you, I am a member of the institute. Now I'm not denying. I'm not in the board of study, but still I'm praising the board of study who have hosted these 2 things. And then of course the third thing which you have to read is practice manual. These things are very important. Maybe you are reading any book, I am not concerned. Read any book you like. I have no concern for that. But I have a concern that you don't have to miss recent test paper, that is RTP. You don't have to revise test paper, meaning you don't have to miss the recent judicial decision hosted on the website of our institute, and of course the practice manual. You do illustration from practice manual, may not do the theory portion. But I am assuring you that about 30 marks to 40 mark paper will come from there only. So this is the hint I have given you. This is the hint I have given you. Please be sure that you have to do everything which I have told you. Now somebody says how to remember that sections, how to remember that cases. It is very difficult. I understand. I can agree with you, you have to do lot of other activities. But have one friend. Have one friend. Every friend is important, I know that. Even that missed call friend is also very important. But have one friend. Prepare, you decide in the morning that today we will do about 30 sections. We have to remember those 30 sections. Then in the evening, whenever you get time, sit together, exchange. Let him first recite what are the sections and what are those contents, and then you check it. Next day you take the responsibility of learning those sections. You have to learn, both of you have to learn. I am not saying that one should learn, both of you, but let one speak on that day, the other speaks the next day. And the choice should not be left to you. You take out a chit, who will speak today, who will speak next day, again check out a chit, who will speak. But you can remember only when either you write, and these days you don't have a habit of writing too much. So then you remember those and then exchange, discuss with your friend, only one friend. More than one is a crowd. Let me tell you, for learning, more than one is a crowd. So have one friend for a particular thing. Decide in the morning what we are to do today. Maybe a topic, maybe a chapter, maybe the sections, maybe the cases. You can take up that today we will be doing all cases relating to PGBP. Do it in the evening. Let him also take out a chit in the evening. Who will speak? Both of you have to prepare. Mind it, both of you have to prepare. And then discuss with each other and let the other find out the fault or the mistake in which whatever you have spoken. So please, this is the only way now. The time is short. Otherwise would have said you should have for each chapter short notes. Not the short notes available in the market. You have to prepare short note yourself. You know what is there in the short note. When you prepare short note, you know what are the points which are there in this point. So do not have any book on short note bought from the market. You should have prepared yourself, but this is no time. This is no time to make you suggestion at this time, because we have left only about 25 to 30 days for your exam, and this is not the time to tell you to prepare now the short notes. But there is a time to read the whole amendment, because those amendments are supposed to come. Now what I am trying to explain, I am starting right from the beginning, and I am coming out what points will be important or relevant for you, and what are the amendments which are there in those chapters. If you start with the income tax right from section 1, you all know what is section 1, but there were some amendment made in section 2. Section 2 is always definition. You should know section 2 is always definition, whether you read Income Tax Act, Wealth Tax Act or any other act in our country, except of course the Direct Tax Code, which was supposed to come, has not come. Otherwise section 2 of every act is definition, and section 1 is the short title, date of commencement and the applicability of the law. Section 2, let me tell you, always have clauses. There are some people think that there is section and under the subsection there is subsection, then after subsection there is clause, after clause there is subclause, and so forth. But let me tell you, there are certain sections in income tax which does not have subsection, which has clauses. Why I am speaking this? Because I have to talk to you many sections where I will not use subsection, I will be using clauses, and you will be saying why I am talking about the clauses. How do you say that there is no subsection, there is a clause? When you don't have a subsection but a clause, it is only when the section heading is generic section, generic, common section for all, like section 2, definition. You don't give definition of one item, you give definition of many terminology. So therefore, section 2 does not have subsections, it has clauses. It has clauses. Section 10, income which do not form part total income, it is a generic section, exempt income. It does not have subsection, it has clauses. Section 24, deduction from house property, does not have subsection, it has clauses, deduction from house property. Section 16, salary, does not have subsection, it has clauses. So therefore, whenever there is a generic section, where there is a Generic means common section for all. You don't have a subsection, you have clause. So sometimes you have subsection, but in cases of generic section, you don't have subsection, it is clauses. Now, the major change in section 2, definition, you are not very concerned, the definitions are not asked. But due to Vodafone problem, a definition was changed in the case of capital asset, section 2 clause 14, an explanation was added in the recent, in the amendment act, Vodafone problem. What is that definition which is changed? The definition of the word property. They have added the property shall include, that is an explanation which is added, the property shall include and shall deem to have always included any right in or in relation to an Indian company or a right of management or right of control or any other right of whatsoever nature. Why I am using this point? Vodafone problem, now you will not get a case of Vodafone because there is an amendment with retrospective effect right from 1st April 1961 in the meaning of movable property, and also definition change with effect from 1st of April 1976 in the case of section 9. But still, I want to tell you little bit of Vodafone to understand the concept, why there is a change in section 2 clause 14, meaning of capital asset, and why there is a change in section 9, that is deemed to accrue or arise in India. The question was, there was a, let's say there was a foreign company X. This company was there outside India. This company had shares in Indian company, and this company sold the shares, this company was share in the, there was a Y Limited company also abroad. X Limited was abroad, Y Limited was abroad. X Limited had share in the Indian company. Y Limited thought that if we go for amalgamation, then the Indian company share will get it transferred. They never did any amalgamation, they did not make any sale. Y Limited purchased the shares of the X Limited. Y Limited purchased the shares of the X Limited in foreign country only. No transaction took place in India. Y Limited in foreign country purchased the share of the X Limited in foreign country, and no transaction took place in India. Y Limited in foreign country purchased the share of the X Limited in foreign country, and no transaction took place in India. But what happened? Due to the share purchased by Y Limited, the control of the Indian company was transferred to Y Limited, because Y Limited took more than 50% shares of X Limited. So control of the Indian company also got transferred to the foreign company. The Department of Income Tax said that there is a transfer and there should be liable to be taxed in India. But the company said, sir, we have not transferred any Indian company share. No Indian company share have been transferred. We have only purchased share of the X Limited company. So where is the question of taxing the capital gain in India, because we have not transferred anything? And they lost the case in Supreme Court. The Department of Income Tax, they lost the case in High Court, but they won the case in Supreme Court, and Department lost the case in Supreme Court. And due to that, the amendment was made not only in section 2 clause 14, it was also made in section 9. It said property retrospective effect shall include and shall deem to have always included any right in or in relation to Indian company, or right of management or right of control or any other right whatsoever nature. Are you understanding what kind of an amendment is brought? That even if there is nothing happened, no transfer has taken place, but since the right of the management has been transferred to the other company, and that's why they are asking for tax from Vodafone. So whatever may happen, that still the government is deciding what to do with this retrospective amendment. But just I wanted to tell you that section 2 was changed only because of the Vodafone. Section 9 was also changed only because of the Vodafone. Section 195 was also changed, and where it was written that even a non-resident who is sitting abroad will be liable to deduct the tax at source for the purpose of Indian taxation if the income paid by the non-resident is taxable in India. If it is deemed to accrue or rise in India, even if the deductor is a non-resident, if it is deemed to accrue or rise in India, even if the deductor is a non-resident, the deductor will have to deduct the tax and says, he cannot say that I am not a resident of a country. Section 195 says every person responsible for making payment of any expense which is chargeable to tax in India, payment of any income which is chargeable to tax in India is liable to deduct the tax at source. Any person. Now they have never defined what do you mean by the person, when we were always taking the definition as person will be resident making payment to non-resident. Now they have added explanation to section 195 saying that this person responsible for making payment of any income to non-resident is chargeable, which is chargeable to tax in India, will be liable to pay tax, meaning thereby even if that person is a non-resident. Even if that person is a non-resident, but if he is making a payment of any income which is chargeable to tax in India, although the payment is made abroad to the non-resident, but since that income is chargeable to tax in India, how it is chargeable to tax in India? Right of management or control has been transferred of the Indian company to the foreign company. So due to that, the TDS will have to be deducted, as the Vodafone problem is only relating to TDS and nothing else. So this was the change which I wanted to tell you, although not very important from examination point of view except the meaning of capital asset. But now the changes in section 10, and do you have to do section 10 or residential status? Let me tell you, first two chapters, you should concentrate on section 9, subsection 1, that is income which is deemed to accrue or arise in India. Out of the first 9 sections, the most important section for you is, if at all you have to do international transaction, if you have to do some international taxation, and if you have to do the taxation of non-resident, it's situated in India, is an income which is deemed to accrue or rise in India. So that point, section 9 is very important. Even salary shall be deemed to accrue or rise where the services are rendered. And then section 915, section 91BI, section 91VII. What are those sections? Interest paid outside India to a non-resident, or royalty paid outside India, or fee for technical services paid outside India shall be an income which is deemed to accrue or rise in India if that money which was borrowed was used in India, if that asset for which royalty was paid was used in India, or if the know-how for which the fee for technical services were paid was used in India. So the most important section, you are very important, I am telling you, is section 9. You have to do that section 9 thoroughly. And one explanation to section 9 is also very important, and that explanation is in relation to the money borrowed, in relation to the fee for technical services, and in relation to royalty. It says whether that money has been used in India or not, whether that non-resident is having any office in India or not. If there is an interest which is payable to a non-resident for money borrowed which is used in India, or maybe it is not, that will be an income which is deemed to accrue or rise in India. Second explanation is very important. That explanation is that even if the non-resident does not have any place of office in India, does not have any residence in India, does not have any presence in India or permanent establishment in India, or even if the asset for which royalty was paid was used in India or not, this is the income which is deemed, or the services rendered in India or not for technical services. Service may be rendered in outside India, but if those services are used in India, or the asset may be purchased outside India, payment may be made outside India, non-resident may be stating outside India, but if that asset is used in India or services are used in India, it is the income which is deemed to accrue or arise in India. So that explanation which is given under section 9(1) is very, very important, which very clearly says that non-resident may not have any office in India, may not have any residence in India, may not have any place of business in India, or that the services may not be rendered by him in India. But if those services are used in India, it is the income which is deemed to accrue or rise in India, and the non-resident shall be liable to pay tax in India. So please concentrate on Section 9. As regards Section 10, many people ask me, sir, what is to be done under Section 10? Let me tell you, most of the section of Section 10 you have done under other chapters. But 3 amendments which have come in Section 10 of the recent amendment, and there is a question in RTP also for those, out of those 3 amendments, 2 questions have been given in section RTP. So please do those 3 amendments positively. One is Section 10 Clause 10D, read with Section 80C. I'll tell you that. Another is Section 10BBH, and the third, of course, amendment is Section 10 Clause 48. These are the 3 amendments which have been brought by the Finance Act 2012. Let me explain you a very important point. 90%, 95% people commit mistake in 80CCD, read with 80C. Now, what is the amendment in 80C and what is the amendment in 1010D? Let me tell you. 80C used to be there that any sum paid as life insurance premium shall be allowed as deduction subject to the maximum of 20% of the capital sum assured. Earlier it was 20% of the capital sum assured. Now, they have made an amendment in Finance Act 2012 saying that if a life insurance policy is issued on or after 1st April 2012, then any sum paid, please note the word paid, any sum paid as life insurance premium shall be allowed as deduction subject to maximum of 10% of the actual capital sum assured instead of 20%. So if the policy is issued before 1st April 2012, it is 20%. If the policy is issued on or after 1st April 2012, it is 10%. But please note the word, don't get lost in 10 or 20%. It is 10% of the sum paid. Whereas in Section 1010D, what is Section 10D? That any amount received on maturity of life insurance policy shall be fully exempt. But there are 3 exceptions, if you remember, in Section 1010D. First exception was any payment for key man insurance policy. So payment from key man insurance policy, including bonus thereof, shall be fully taxable, although maturity amount from life policy is exempt under 1010D, but payment from key man insurance policy is not exempt. Then any policy taken under 80DD, that also is there, which is not exempt. But third was, now read the word which I want to say, any sum payable, please note the word, payable as life insurance premium during the previous year shall not be, then if it exceeds 20% of the capital sum assured, then the whole of the amount on maturity will be taxable. What was the law? 1010D, sum payable, please note the payable, as life insurance premium, if exceeds 20% of the capital sum assured, the maturity amount is taxable. Please note the word payable. And now it has been reduced to any sum payable as life insurance premium if a policy is issued on or after 1st April 2012, then if it is paid more than 10%, sum payable is more than 10%, then it is, the whole maturity amount is taxable. Please note the word. Earlier it was in 1010D, sum payable 20%. Now sum payable 10%. Even in 80C it is 10 and 20. What is the difference? In 80C the word used is sum paid. In a 1010D the word used is sum payable. You will say, what is the difference? I'll explain. Suppose you have taken a life policy after 1st April 2012, but the premium payable, premium is 8% of the sum assured. Premium is 8% of the sum assured. Now suppose you have not paid any payment in 2012-13, you did not make any payment. You made the payment in previous year 2013-14, 8% of 13-14 and 8% of the previous year, 16%. Now the payment made is 60%, but the amount payable per year does not exceed 8%. The law says under 80C, it will be restricted to 10%. Sum paid. So paid in 13-14, 8%. But previous year also paid in 13-14, 8 plus 8, 16. Deduction will be allowed, not of 16%, but 10%. But wait. How much was payable per year? 8%. So therefore, under 1010D, maturity amount shall be fully exempt because sum payable per year does not exceed 10%. It is 8%. Although in the current year you have paid 16%, but that 16% is on account of 2 years. Maybe 80C will restrict it to 10%. 80C will restrict it to 10%. But 1010D, payable per year is 8%. So therefore, on maturity, the amount shall not be taxable. It will remain exempt. It's only per year the sum payable is more than 10%, then only the maturity amount on policy will become taxable. So please note the difference. In 1010D, it is payable. In 80C, it is paid on account of life insurance premium, whether paid for current year or the previous year, limited to 10%. But here, per year policy amount payable if exceeds 10%, maturity amount taxable. If does not exceed 10%, maturity amount is not taxable. So this is the point which I wanted to tell you. 1010D. Next thing, a very interesting point. Prasar Bharati Broadcasting Corporation of India, income has been now made exempt under section 10 BBH with retrospective effect. They forgot to give the exemption to Prasar Bharati Broadcasting Corporation of India. So that is exemption given there. Very interesting change, and there is a question in your RTP on 1010D which I have just explained, and there is a question in RTP on 1048 also. What is 1048? You know, there are sanctions imposed on Iran. We are importing crude oil from Iran. We can't make them payments in dollars and all that. Now what is the law has been made is only for this purpose, that if there is a specified company, which a foreign specified company which are supplying crude oil to India in Indian currency, a foreign specified company who is supplying crude oil to India in Indian currency, and the payment of that crude oil is made in India, the law says still this income will be exempt. Why this has been done? Try to understand. Even if you are a non-resident, two incomes are taxable in India, even if you are non-resident. One is scope of total income, section 5. Incomes received in India or deemed to be received in India, income accrue or arise in India, or deemed to accrue or arise in India. Now, listen to me. Supply of crude oil is from foreign country, but the payment is made by the Indian company to that foreign company in India in Indian currency. So where it is received? It is received in India. So that means that foreign company should pay tax in India because the income is received in India. To get rid of this problem, because we want that we can import our crude oil in Indian currency and we can make the payment to that company in India, in a bank, may deposit in a bank in India, and whenever anything is imported by that country, they will make the payment through that payment which is lying in Indian currency. The payment, you know, this is quid pro arrangement. We are buying oil from them, making the payment in Indian currency, they will be buying goods from us and they will make the payment from here in India also from that Indian currency. So 1048 was brought that income of a foreign company who sells any crude oil from a country outside India to India in an Indian currency, its income will be exempt if certain conditions are satisfied. The condition number one was this foreign company has entered into an arrangement or agreement with the central government or with any other person which is approved by the central government. There is an arrangement or agreement between the foreign company and the central government or any other person which is approved by the central government. And the foreign company, as well as that arrangement or agreement, has been notified by the central government in its gazette. What I am saying, that foreign company is also notified and that arrangement or agreement has also been notified by the central government in the official gazette of India. And third, that this foreign company does not have any other income. The income relating which is only concerned to the activity of supply of goods. There is no other activity of that foreign company in India. There is no other activity except this activity of foreign company in India. So the total income will be exempt. You will see in RTP that foreign company is supplying goods in an Indian currency and still we are giving exemption provided those three conditions are satisfied, starting from they have entered into an arrangement and agreement, and this arrangement and agreement and company is notified, and there is no other activity of the foreign company except the sale of crude oil in India. So that is the point which I wanted to tell you, a very important point. So next, after section 10, let me tell you, there is no change in the salary chapter. So let us not waste much time in salary chapter, just a hurried go through. You have done in IPCC also, and unless and until there is some significant change, normally they don't ask question from salary chapter. The best you can do is how to value the ESOP, that's all. Otherwise salary chapter, they will ignore the question unless and until there is some amendment. So don't waste your time much there. Then the next chapter of course is this was salary chapter 15, 16, 17, and the next of course is your chapter on business, income from house property, starting from section 22 to 27, and let me tell you, there is nothing much change, no change at all. So why should you waste your time in going through all those chapters on house property? Very rarely a question will be asked, very rarely. So there is, just go through once, hurriedly, and don't waste your time. Coming to now, chapter on PGBP, which everybody says is very, very important. But let me tell you, please do this chapter last of all. First revise all other chapters, because this is a very lengthy chapter. First revise all other chapters, do not involve much of time. And secondly, whenever you revise this chapter, do not do first 30 to 37 section. Don't do those sections first. First do section 40 to 44 dB. They are more important than section 30 to 37. 40, section 40 clause A, section 40 clause B, section 40 clause B A, section 41, section 42, section 43(1), section 43 A, 43B, 43C, 43D. These are the sections 44, 44AA, 44A, 44B, 44BB, 44BBB. You have to do, and then 44AD, 44AE. These are the sections which are supposed to be done. So first revise section 40 onwards, and I'll tell you what is important there. Wait a minute. And then, if at all you have to come to section 30 to 37, please don't waste your time in 30 section or 31 section. Read 28 section, agreed, because that includes losses also. There is nothing in 29 section. 30 is repair insurance premium of business premises. Don't waste your time. 31, don't waste your time. 32 also, don't waste your time, lot of things in 32 depreciation. Everyone knows how to perform a block of asset and how to charge depreciation. Do special provisions of only special provisions relating to depreciation, like slum sale, how to compute return on value where there is a slum sale, how to calculate proportionate depreciation where there is a predecessor and the successor due to amalgamation, due to demerger, due to the partnership firm taken over by the company, a sole proprietor firm taken over by the company, due to succession. All those problems of proportionate, number of days used, proportionate depreciation, that point is important. Why you are waste your time in calculating depreciation? You don't need to remember also the rate of depreciation. Don't need to remember. Do the special point like additional depreciation. Yes, you have to do additional depreciation, and there is a change also in the additional depreciation. Unless the earlier additional depreciation was allowed only to the assessee who is engaged in the business of manufacturing or processing of article or a thing. As regards generation of power, some judgment was there for a tribunal, it is manufacturing. Some judgment was there, no, it is not. But now what have they done? Additional depreciation will also be allowed to power generating unit. They will, power generating assessee shall also be allowed additional depreciation of that 20% or 10% depending upon the number of days it is put to use and installed. So that additional depreciation has been extended to, that's why I am saying, to power generating units also. So therefore, please read in depreciation, unabsorbed depreciation treatment, read partial unabsorbed, proportionate depreciation, how to compute slum sale, and don't waste your time in calculating depreciation. Otherwise it will take 3 hours or 4 hours or maybe even full day to read depreciation. There is no need. Concentrate on 31st time, section 35, expenditure on scientific research, and very important is section 35(2)(ab), which is recently amended. You know that earlier, in case of a company who is engaged in the business of manufacturing or processing of article or a thing, 200% deduction is allowed for scientific research which is sponsored by the prescribed authority, but deduction on building was allowed 100% and land it is not allowed. But that was going to be there was a sunset for that up to 31st March 12, but the recent budget has extended to 31st March 17. The why I am saying that is 200% deduction is there for any revenue expenditure or capital expenditure incurred, except for purchase of land which is not allowed, or except or purchase of a building which is allowed 100% in a normal case, but it is only for company assessee. So concentrate on 35(2)(ab), concentrate on 35(2)(AA), and concentration of section 35(1), expenditure on scientific research. Whether you are allowed prior period expenditure, it is allowed only in the 35(1) case, not in 35(2)(ab) case. So that point, scientific research is very important. Concentrate on scientific research. See little bit of 35(ab)(b), license to operate telecommunication services, but don't waste your time on 35(ac), or don't waste your time in 36 section. These are very simple section. Remember only the provisions relating to gratuity, provident fund, and the welfare fund. Employee contribution, employer contribution, and provision relating to gratuity. The others are not very relevant. 37 is a general section that you are more concerned with the cases relating to 37 and not for any other thing. So there is nothing to worry about that. But please concentrate on section 40AIA, because there is a very important judgment, amendment which is made in section 40AIA, read with section 201. 201. What is the amendment in 201, which I'll come to section 40AIA also. Let me explain. What happened so far, if the tax is not deducted at source, in case of interest, rent, commission, brokerage, fee for technical services, fee for professional services, royalty or payment to contractor, if the TDS is not deducted or if after deduction it is not deposited before the due date of furnishing the return of income, that expense was not allowed as deduction. That expense is not allowed as deduction, and later on it is written that if in a subsequent year the tax is deducted or deducted earlier year, deposited after due date, the deduction will be allowed. But wait a minute, we used to say to the department, sir, I have not deducted the tax. Okay, but the deductee has paid tax on that, because section 191 says if the TDS is not deducted, then the deductor will have to pay advance tax on that. So sir, deductor has already paid the tax on that. Now you are not allowing me deduction because I have not deducted, and you will give me deduction only in the subsequent year when I deduct it. Sir, how can there be double deduction? One deduction by the deductee has already paid tax, and now you want me to deduct the tax again? We were always telling that, but nobody was listening to that. But thank God, amendment was brought in section 201. What was that amendment? Which is also read with 40IA, which is also read with 201A. What is that amendment? The amendment in 201 is that where the deductor has failed to deduct the tax, please note the word, the deductor has failed to deduct the tax, but the resident deductee has filed his return of income under section 139, and the resident deductee has included such income on which tax was not deducted by the deductor. He has included such income in his return of income, and the resident deductee has paid a tax which was due on the basis of its return of income. Three conditions. Resident deductee has filed return under 139. 2. Resident deductee has included such income on which tax was not deducted at source. 3. Resident deductee has paid tax based on his return of income. And 4. The deductor has furnished a certificate from the chartered accountant that the deductee has satisfied all those three conditions. Then section 201 says assessee will not be treated as deemed to be in default. Assessee will not be treated as assessee deemed to be in default. And second, even the interest which is payable, that interest will be payable only from the date it was deductible to the date of filing the return of income by the deductee. Two changes. 201 says assessee shall not be deemed to be in default. 2011A interest says interest will be payable now from the date it was deductible to the date of filing the return by the deductee. Date of filing the return by the deductee. Since this is a relief now that you don't have to deposit the tax again if you can prove that tax has already been paid, and secondly, interest liability has also been restricted up to the date of filing the return. So 40A IA has also been amended. What is said in the 40A? Provided that if the assessee has not been treated as assessee deemed to be in default under 201, assessee has been not treated as assessee deemed to be in default under section 201, then it will be deemed as if the tax has been deposited by the deductee, by the deductor, shall be deemed to have been deposited by the deductor. But the only difficulty is that you will be able to produce certificate only next year on the date of return. So therefore, in this year it is going to be disallowed. But next year when I produce a certificate of the return filed by the deductee and satisfying those conditions, then next year I may not deduct the tax. Again, I will be allowed deduction provided I give a proof that the chartered accountant certificate that deductee has already paid the tax on that income. Very unfortunate. It should have been deemed to be deducted in the previous year. but it has said it shall be deemed to have been deducted on the date of filing the return. So therefore, there is going to be some problem, but 40A now, you will not get deduction this year. Obviously, you get next year when you satisfy those 4 conditions, but there is no need to deduct the tax second time. So this is 40IA amendment read with section 201, read with section 2011A. 11A regarding interest, one assessee not held to be deemed to be in default, and then 40AIA that you need not deduct the tax again. So this is the amendment which is very important, and I should tell you that you can expect a question like that on this amendment also. So the next amendment is very simple. 44AB, the limit of 44AB, which was earlier 60 lakh, has been raised to 1 crore. A limit of that 15 lakh in case of profession has been raised to 1 crore. 25 lakh. So that is the point which you have to be very clear about it, that the limit of 44AB has been raised. So this is the another change which has taken place in your business chapter. Another change is what is the due date of filing the return. In 44AB they have said the due date of filing the report of chartered accountant under 44AB will also be the specified date mentioned under 139(1). So that date will be 30th November, 30th September. How will November will come, I'll tell you. Next point, very important change. 44AD, presumptive income. You can expect a question of presumptive income now. But what is presumptive income? You know that 8% you have to turn. But 3 things will not come to, 3 types of business will not come to presumptive income. One is any income from a profession referred to in section 44AA. So profession referred to in 44AA will not come under 44AD. Then if you are carrying on a business and getting commission or brokerage from that business, you will not be covered under 44AD. And the third, of course, is you are carrying on an agency business. So if you are carrying on an agency business also, you will not be covered under 44AD. So therefore, now I am coming to, these were the amendments. Amendment in 44AD, amendment in 44AB, amendment in 40AIA, amendment of course in 32 chapter. But there are 2 very important things which are given in your amendment, and where RTP contains that question, that is expenditure on agricultural extension project and skill development project. 2 more sections have been inserted. One is 35CCC, 35CCC. In 35CCC, let me tell you, it is agricultural extension project. If you incurred an expenditure on agricultural extension project to be notified by the central government, then you will be allowed a weighted deduction of 150% of the expenditure so incurred. That is, agricultural extension project will be notified, mainly related to research in agriculture or scientific development in agriculture, but that is to be notified. But if you incur, there is a practical question in your RTP relating to this 35CCC getting a deduction of 150%. And secondly, skill development project. This deduction will be allowed only to the company, and not to others. 35CCC, there is no restriction, but 35CCD only to the company, and that too for skill development project to be notified. Expenditure will be eligible for deduction, weighted deduction of 150%, but no deduction for land, acquisition of land or building. You can claim deduction for building under depreciation, but not under 35CCD. So this point, please, 35CCD is for a company. It is for skill development project. Which project? To be notified by the central government. But expenditure 150%, but not allowed for land and building. And a very important, and again RTP contains that question of that amendment 35AD. You know that under section 35AD, capital expenditure incurred for eligible business is allowed as deduction 100% under eligible business 35AD. 8 businesses were already there. Now 3 businesses have been added. Now there are 11 type of a business for 35AD where capital expenditure except on land, financial instrument and goodwill is allowed as 100% in the very first year. And those 3 business which are added is setting up and operating an inland freight container or container freight depot approved as notified by the custom under the Custom Act, or beekeeping or making honey and bee wax, and then setting up and operating a warehouse for storage of sugar. 100% for warehousing of sugar, beekeeping, honey making or bee wax, and of course inland freight container freight depot. These 3 added from this year. But very interesting, if you for 5 businesses which I'll mention, if they commence their business, 5 businesses commence their business on or after 1st April 2012, please, on or after 1st April 2012, you will be allowed weighted deduction of 150% instead of 100%. What are those 5 now? If they have commenced business before 12, no question. If they have commenced business on or after 1/4/12, you get 150%. The first is the same, set up and operating a cold chain facility. Second was set up and operating a warehouse for storage of agricultural commodities. Third is affordable housing scheme. Then setting up and operating a hospital of 100 bed anywhere in India. And last is production of fertilizer. In these 5 businesses, if you commence your business on or after 1st April 2012, my dear, you will be getting a deduction of 150% of the actual expenditure incurred, capital expenditure incurred, except for purchase of land, goodwill and financial instrument. So very important, your RTP contains this question where the expenditure have been incurred for 35AD and you are eligible for 150%. So that point is also very important, I told you. Coming to now capital gain. Please don't waste your time on the whole chapter. You know how to compute capital gain. You know what is indexation of cost, what is the cost. Concentrate on section 45(2), conversion of capital asset into stock in trade. Section 45(3), introduction of capital in kind by the partner or the member into the business of a firm or AOP. Concentrate on section 45(4), distribution of assets in kind at the time of dissolution of a firm. Concentrate on section 45(5), compulsory acquisition. So 45 section. Then go to section 50, 50A, 50B. 50 is block of asset. 50A, you know that electricity undertaking, sale of an asset. 50B, slum sale. 50C, that stamp duty price. 50D, recently added, that is if the consideration price is not ascertainable or indeterminable, then you take the market value as the consideration price. Concentrate on that. 46 subsection 1, 46(2), 47A. Concentrate on these 47A, and then don't waste your time to do all the exemptions. Main exemption 54, 54EC, 54F, and the recently inserted 54GB. Expect a question on 54GB. What is 54GB? Long-term capital gain from transfer of any residential property being land and building, land and or building. Long-term capital gain in case of an individual or HUF shall be exempt proportionate to the net consideration price so invested in the subscription of the shares of a closely held company to be incorporated by you, subscription to the closely held company to be incorporated by you, and that subscription should be made before the due date of furnishing the return of income, and then you will get this exemption. But there are conditions on the company also. The company which has received this subscription should utilize this money for purchase of plant or machinery within 1 year from the date of the subscription. They should invest this money in eligible plant or machinery, and there is a lock-in period that you cannot transfer those shares for 5 years, and you are also not allowed, the company is also not allowed to transfer those eligible assets for a period of 5 years. If they transfer, if you who got an exemption under 54 GB transfer your shares within a period of 5 years, then what will happen? Whatever capital gain, new capital gain on transfer of share, that is going to be taxed. But whatever the capital gain which was exempt under 54 GB due to this exemption will become taxable. So two capital gain. 54G exemption will become taxable now, and new capital gain on transfer of share will also become taxable. And if the company transfer the plant and machinery within 5 years, company will be taxable on capital gain, if any. Please note the word if any, on transfer of plant and machinery. But individual HUF will be liable to pay capital gain tax on which he has not paid under 54 GB earlier. So this section is very, very important for individual HUF. Kindly do it thoroughly. That's much only capital gain. But two more important in capital gain, 111A and 112. 111A and 112. These two you should do. Don't waste much time on that, because these you have done under IPCC also. Coming to income from other sources, concentrate on 2-3 things. One is section 2 clause 22E, deemed dividend, rather full chapter 222A, 222B, 222C, 222D, 222E. Very important. Read with section 115O, but 222E please do, and then 3 more sections, very important. Section 56, subsection 2, 7, gift of movable property or immovable property from unrelated person. Section 56, 2, 7A, gift of share received by a firm or a closely held company. Section 56, subsection 2, clause 7B, a very important amendment which has been brought. What is that amendment? Normally what happens? Company issues shares at a premium. A new company, how can you think of issuing a share at a premium? But they have been doing it at a premium. Now what is the restriction imposed? That if a company has issued any share more than its face value, then if the sale price exceeds the fair market value of that share, if the sale price exceeds the fair market value of the share, then the difference will be treated as the income of the company. Meaning thereby, let me explain. Suppose the face value of the share is 10 rupees. It has been issued for 220 rupees. 220 rupees. Market value of the share is, let's say, 240 rupees. Now, 10 rupee share issued for 200 rupees. Meaning thereby that you are covered under 56(2)(b. But how much price you are issuing? 200. What is the market value? 240. There is no problem. If it is the issue price is more than fact market price, then there is a problem. Suppose the issue price is 320 and the market value, and market value is 200. Market value of the share calculated on the basis of computation of market value, fair market value, 200, and issue price is 320. So what is the difference? 120 per share multiplied by the number of share issued will be treated as the income of the company taxable under section 5627B. What have you to see? There are two part. One, share issued price is more than face value of the share. That is your cover under 56.7. But liability will arise, income from other sources will arise only when the issue price is more than the face value. Please, issue price is more than the face value. If issue price is less than the face value, there is no problem. If the issue price is more than the face value, how to calculate face value? Either you know on the basis of book value, 11 UA, or net asset method. They have prescribed do it on the basis of net asset method, and then 5627 is very important. My dear, the next very important. I'm telling you, after I complete this another 10-15 half an hour, I tell you how to prepare the bank. But 68 section, very important change, very important change. So far, what is in 68? If any amount is found credited in the books of account, and if the assessee does not offer an explanation, or offer an explanation which in the opinion of a name of the shareholder, the address of the shareholder, the PAN number of the shareholder, I have discharged my obligation, so I need not prove the source of the source. I need not prove what is the source of that shareholder. I must only tell name, address and everything. But now the change. If we have received any share application money from any shareholder, then the company will be under an obligation to prove the source of the source. What is that? That where from the, who is the person who has given that money, name of the shareholder, not only the name and address of the shareholder, source of the shareholder, from where that shareholder, from where that money has been earned, what is the source of the income of the shareholder who has made investment in your company. This is for closely held company, no doubt. For a closely held company, now it will not be sufficient that you give the name of the shareholder, address of the shareholder, PAN number and other details. Now, source of the source. What is the source of income of the shareholder who has invested into your shares? If you are not able to prove the source and source, or if it is not found satisfactory, then whatever is the amount found received as application money will be taxable as income of the company, as income of the company. So the whole share application money of which you are not able to prove source and source will become not the income of the shareholder, income of the company. And the another point, you all know, very important point, expect a question 68 read with 115 BBAE. Now what is 115 BBE? You know, unexplained income is found either in 68 cash credit, 69 unexplained investment, 69A money, bullion, jewelry found which is not disclosed, or 69B investment not fully disclosed, 69C unexplained expenditure, 69D amount borrowed or repaid other hundi without account paid check. Now for that, earlier what used to happen, that this was treated as undisclosed income but taxable at a normal rate applicable to the assessee. Like if there is an individual and if there is an undisclosed income under 68, 69, 69A, 69B, 69C, 69D, what will happen? The slab rate will become taxable. But now 115BBE, what does it say? if there is an undisclosed income found under section 68, 69, 69A, 69B, 69C, 69G, and this income is included in your total income, then this much of income which relates to this section shall be taxable at a special rate of 30%, will be taxable at a special rate of 30% and not at a rate of the slab rate. So meaning thereby, now it is a special rate given under 115 BBE, 30% for undisclosed income. This is one point. Another point, concealment of income. The minimum penalty will be 100% of the tax ought to be evaded and maximum 300% of the tax ought to be evaded. What happened? Earlier, it was tax ought to be evaded was calculated on slab rate. Now tax ought to be evaded is 30%. So 30% tax ought to be evaded. Suppose the tax 10 lakh rupees is found as undisclosed income. The tax payable will be 3,09,000 plus 3%, 3,09,000. Then what is the penalty? Minimum penalty 3,09,000, maximum penalty 9,27,000. 9,27,000. So earlier the tax ought to be evaded was calculated on the basis of slab rate. Now tax, if it is taxable at slab rate, if it is taxable at flat rate, there was no problem. But now a special rate for such type of undisclosed income. So please, section 68 plus the other section read with 115 BBE, read with section 270(11)C will put everybody into difficulty. So please remember that now it is 30%. If your total income includes such income, taxable at 30%. So this is the change in section 68. So expect a question and read with section 115 BBE. Next change. Let me tell you why I am concentrating on these amendments. I am not doing only amendments. I am also telling you which topic to prepare. So prepare 68 to 69D, important. 68 to 69D. Let us come to section 80. Well, it's never a practical question. There may be a tail or practical question in section 80. 80C to 80U. Don't expect a theory question there. But what are the major change? You can get a practical because of that major change. One, 80C I told you, sum assured 10% of the capital. 80D, preventive health checkup scheme. Although under 15,000, but you can go for preventive health checkup. Amount allowed as deduction 5,000 for all, for spouse, for children, even for parents together and yourself. Maximum 5,000. But that 5,000 is not extra. That 5,000 is not extra. That is for preventive health checkup. It is in the limit of that 15,000. Now, even if you are senior citizen, for senior citizen you know that for parents there is a separate parents there is a separate 15,000. For you, your spouse and children there is a separate 15,000. Wait. For a senior citizen it is separate 5,000. But for preventive health checkup, the total amount is 5,000. Whether it is spent for yourself, your spouse, your children or even your parent, total is 5,000, and that is also within the limit of that 15,000. Within the limit of that 15,000 for you or your parents, separate parents. But only one change. That preventive health check amount you can pay in cash also. Preventive health you can pay in cash. Don't waste your time much in 80C or except 80D, which I have told you. Don't waste your much time in 80DD or 80DDB or 80E. There is nothing much. 80G, there is a change. So therefore you can expect a tail in some question. The donation has been given to the approved institution or 80G, but if the amount of donation exceeds 10,000, it will be paid by check. So if it is paid by cash, it will not be allowed. 80G and 80GGA. So remember, donation amount if exceeds 10,000, now it is allowed as deduction only if it is paid by check. and not by cash. Cash donation after above 10,000 not eligible for deduction. So this is point you should remember. They may ask something on this. Next change. Expect they may ask a question on 80 CCG and 80 TTA. These are two important. 80 CCG is a failure scheme. It is case of an individual who is a retail investor. He has invested in the notified shares of the listed company, and his gross total income does not exceed 10 lakh. He is a retail investor. Then he will be allowed a deduction of 50% of the amount invested, maximum 25,000, and that too the lock-in period of 3 years for shares, 80 CCG. So you can just go through, but important is 80 TTA. Nobody can come to know, but there is a deduction allowed to individual HUF from interest on saving bank deposit. That saving bank may be the cooperative bank, maybe with the scheduled bank, or maybe with the post office, a deduction of 10,000 rupees maximum. Actual interest maximum 10,000 under 80 TTA. This is for individual HUF resident in India. Resident in India. So please tail to some question, maybe 2 marks, 1 mark, 3 mark, 80 TTA. So tail to some question. Be concentrate on this. Next change of course was, now next chapter what? Let me explain. Now we have done gross total income and deductions. So we have computed the income. Now we come to different point. If 90% time you don't get a question on assessment of individual, but you may get question of assessment of company, maybe on firm. But one thing has been recently added, so that's why you should be very clear. AMT, this is a new amendment, alternate minimum tax under 115 JC to 115 JF. So be careful about alternate minimum tax applicable to non-company assessee, because company assessee are already there where under MAT. It is alternate minimum tax. What does it say? If the tax calculated at the rate of 18.5% of the adjusted total income, please note the word 18.5% of the adjusted total income is more than the tax calculated as per normal provisions of the Act, then your adjusted total income will be treated as your total income and you will have to pay tax at the rate of 18.5% plus 3%. What does it mean? Adjusted total income. It is in case of non-company assessee. What is adjusted total income? Two things. You have claimed deduction under 80IA to 80RRB, and or you have claimed deduction under 10AA. Let me explain to you. If you have not claimed any deduction under 80RRB, 80IA to 80RRB or 10AA, AMT is not applicable. If you have not claimed any deduction under 80IA to 80RRB, or if you have not claimed deduction under 10AA, both deduction not claimed, you are not covered under AMT. Suppose you have claimed deduction under 80IA to 80RRB and or 10AA. So how do you compute adjusted total income? You have the total income. Add these deduction. What are these deduction? Deduction claimed under 80IA to 80RRB or deduction claimed under 10AA. Add. Calculate. This is called adjusted total income. Very simple. That is your total income plus deduction claimed under 80IA to 80RRB or deduction under 10AA. Add. Adjusted total income. Now, if this adjusted total income is more than 20 lakh, then only you come under AMT. If it does not exceed 20 lakh, you even though you have claimed deduction, you don't come under AMT. So AMT applicable only when adjusted total income more than 20 lakh. Now calculate 18.5% of adjusted total income, and if it is more than your tax on normal provisions, then pay tax as per 18.5% by assuming your adjusted total income will be your deemed total income. Yes, like MAT, you will be allowed credit for this amount also. Like MAT, you will be allowed credit, this is called AMT credit for next 10 years. But AMT is important because you may get a question on partnership, you may get a question on individual, you may question any person other than AMT is applicable. It is applicable to individual, it is applicable to HUF, it is applicable to firm, it is applicable to AOP, BOI. So therefore, be careful about AMT. Next slide. Please come to partnership firm. Only read 40B. 78. For partnership firm, two sections important. 40 clause B, 78 of losses. How to carry forward the loss if there is a dissolution or retirement of a partner. 78 and 40B, the partnership is over. Individual, along with AMT, everybody knows. Come to company. For company also you have done all chapter. One important is MAT provision. You know, you have done so much of MAT provision. Small change has taken place in this year, nothing much. So MAT provision, this means about revaluation reserve. And for life insurance corporate business, it is not covered under MAT. Otherwise, MAT provisions are same. MAT, you have to do. Section 79, carry forward of losses of closely held company, minimum 51% shareholder as on the last day when the loss was incurred, as on the last day when the loss is set off, should be same. 79 section. Mind it, section 179 and 222E. 179 is private company gone into liquidation, who the directors will be liable. 222E, closely held company giving advance or loan. Please remember, that is also very important. Closely held company. Do it. I have not touched the chapter on setup and carry forward. Please do that chapter thoroughly, particularly 72A, 72B or 73A, that setup and carry forward. Now, assessment of charitable or religious trust. You will have to do it. You will have to do it. But wait, whether they are covered under 1023C or 1020 or 11 and 12, that 25 lakh, you know, if they were covered under advancement of any other object of general public utility, and if they were doing any commercial transaction or doing any trade, commerce or business, then if your gross receipt exceeds 25 lakh, the whole amount was taxable. And if does not exceed 25 lakh, you could continue to claim exemption either under 1023C or under section 11. Now, the amendment what has taken place, that even if you are crossing 25, your income will become taxable, but there is no need to cancel your registration under section 12AA or withdraw your approval under 1023C. Because it is possible, this year you are more than 25, next year you may be less than 25. So even if you are more than 25, your income become taxable, but 12AA registration will not be cancelled, 1023C approval will not be withdrawn. That is the amendment which has been brought. And the RTP question contains that, is it necessary to withdraw the registration or approval? The answer is no. Not necessary to withdraw the approval. You may pay tax this year, but next year you may not pay tax. Registration is there, but exemption may not be given to you if you cross the 25 limit of a commercial activity. So that point you should very clear. Please, for cooperative society, I can't give you the chances. For cooperative society, please do ATP. ATP is very important. For corporate, if you understand ATP, everything is clear about ATP. So ATP, For AOP BOI, very simple. If AOP BOI, other than society or cooperative society, if shares are indeterminate, you know that maximum marginal rate of tax is there. And if there is a foreign company, higher rate of tax is there. And if no member of the AOP has an income exceeding exemption limit, and foreign company is not a member, and the shares are defined, AOP is taxable at normal slab rate. When AOP is taxable at normal slab rate, remember 86 and 110, that you have to include that share of profit of AOP in the income of the assessee, and then claim a average rate of tax, a rebate under section 86. So that point of AOP is important. Coming to the next. Sir, whenever you are going to do non-resident taxation, do all these chapters simultaneously. Number 1, section 9. Number 2, chapter 12, relating to special rate of tax in case of resident and non-resident, but chapter 12, 12A, special provisions relating to non-resident Indian. So, section 115A, 115AB, 115AC, 115AD, 115BBA, 115AD, 115, right, then 115C to 115I. Then please, in case of non-resident taxation, please do double taxation section 90 and 90A, 91 here only. Do advance ruling here only. Do transfer pricing here only. So all non-resident chapter should be done in one go, starting from double taxation relief, transfer pricing, what you call advance ruling, taxation of non-resident, including special rate of tax under section 115A, 115AB, 115AC, 115AD, 115BBA, 115 what you call C to I. Very important section. And then please one more section. Although it was there last year, this year also, 115 BBD is, BB has been extended. What is that? If an Indian company holds 26 voting power in a foreign company, subsidiary, and if the dividend is received from foreign company in India, then it will be taxable at a special rate of 15%. 15%. Please do 115 BBD thoroughly. 115. Next change, and very important, you cannot escape the assessment procedure. Sometimes question of 5 marks is asked, sometimes even 20 marks. So whenever you are doing assessment procedure, please do assessment procedure for income tax and wealth tax simultaneously. Assessment procedure for income tax and assessment procedure for wealth tax are quite similar. Like filing of return, there also similar. So assessment procedure for income tax and wealth tax, do it thoroughly. Don't escape assessment procedure. Then also please do settlement commission and search cases under that. Settlement commission, search cases under that. I'm telling you, do them combined. Assessment procedure starting from filing of return 139.1, 139.3, 139.4. The sections you have to remember, all these sections for assessment procedure. 139.4 belated return, 139.1 filing of return, 139 3 loss return, 139.4 belated return, 139.4A return of charitable trust, 139.4B return of political party. You can remember these sections provided you have a friend and exchange that. 139.4C return of certain institution claiming exemption under 10, 139.4D return of university or educational getting donation under 35. Do that. And then also when you are not supposed to file a return. And very important amendment, in case of a resident in case of a resident who has any foreign asset situated outside India, or any operation of any account outside India, or any interest in the foreign entity outside India, he has to file a return, that resident, even if his total income is not taxable. So if there is a resident whose total income is not taxable, he is not covered under 139(1), but who has any foreign asset, including any financial interest in an entity outside India, or who has a right to operate any account outside India, the return of income in his case is necessary. Even if he is not covered under 139(1), return has to be filed. So that point should be kept in mind. Also kept in mind, when return need not be filed if your total income does not exceed 5 lakh and your interest income does not exceed 10,000. Remember the form also, all form numbers, Sugam form, Sahaj form, form 2, form 3, form 4, form 5, form 6, form 7. These are practice oriented subject. Then very important section 142(1). Please, 142(1), 3 things: notice for filing a return, notice to produce books of accounts and document, notice to furnish information. 142(1). 142(2), what is that? Inquiry from outside. 142(2)(a) to 2(d), audit, special audit. 142, 142(3), opportunity of being heard. Do that 142 seriously, it is important. Then 143(1), 143(2), 143(3), 144, you have to do them seriously. Then 147, there is a change in 147. You know that accounts can, reassessment can be done for maximum of 6 years, 4 years and 6 years. Now for resident who has a foreign asset, person who has a foreign asset outside India, or entity outside India, or operation outside India, the case can be opened for 16 years, not for 6 years, 16 years. This is 147, or read with 149. You should be very careful for that. Please do that thoroughly. Then, time limit for completion of assessment, which earlier was 21 months or 9 months, now it is 2 years or 1 year. And even for those referred to TPO, where it was 33 months, it is 3 years. So completion of assessment under 153, you can get a small question. What is the time period for completion? It is given in RTP also. Please read that completion period. It has been extended by 3 months. Now it is 2 years or 1 year or 3 years, as the case may be. Do that. That is important. That is important. Then next point, which is very important, is in TDS there are small changes. One, that in case of company debentures, you know that the TDS which can be now after 1/7/2012, if it is given, the interest on debenture given by the company which is widely held company to any individual or HUF who is resident in India, and it is paid by account paid check, whether the debentures are listed or non-listed. Now no TDS up to 5,000. Earlier it was 2,500, but that was only for listed. Now listed or unlisted, 5,000 from 1/7/2012. That important point is also there. And in the case of non-resident sports person and non-resident now foreign entertainer also, the TDS rate has been increased to 20% from 10%. And foreign entertainment are also included now under 115 BBA. That is, their income is liable to be taxed at 20%. Remember that point also, it is very important. Then in one important point, very small question can be asked, director. If the director is an employee and getting any amount, it is covered under 192. If the director is not an employee, getting any remuneration, getting any commission, getting any amount, meeting fee or etc., covered under 194J. Let me tell you, there is no threshold limit in case of director. In the case of fee for technical services, fee for professional services, royalty, non-compete fee, there is a limit of 30,000 threshold limit. But for director, there is no threshold limit. Even you pay 200 rupees, TDS has to be deducted at the rate of 10%. So be careful about 194J director, 194J, director, don't give the exemption of 30,000. So this is also the change which you must know. And then there is a change in 206C TCS. If you make a sale of bullion or sale of jewelry, bullion exceeding 2 lakh and jewelry exceeding 5 lakh, and if you receive a payment in cash, the seller will have to collect a TCS at the rate of 1%. Jewelry 5 lakh exceeding 5 lakh, bullion exceeding 2 lakh, seller will have to collect only when he receives the payment in cash. Only when he receives the payment in cash. Otherwise, no. Second point. 206C is also added for minerals like coal, lignite, iron ore, 1% TCS. So be careful about 1% TCS. And let me tell you, when you do TDS, start with like this. Try to do the TDS like this. General provisions there. Start with that first thing you want a TDS, you have to deduct it, you have to have a 10 number. You need to have a 10 number and apply under 49B. Then what is the time limit of deducting the TDS? There are two time limits. One, at the time of making payment, or at the time of making credit, or making payment or credit, whichever is earlier. Only 5 sections TDS to be deducted at the time of making payment. In all other section, it is at the time of making payment or at the time of credit, whichever is earlier. What are those 5 sections where TDS to be deducted on cash payment basis? Number 1, it is salary. Number 2, it is 194B, winning of lottery, crossword puzzle. 194BB, horse race, payment from which National Saving Scheme. 194EE and 194LA, it is compensation, compulsory acquisition. In 5 cases, it is at the time of making payment by cash, check, draft or any other mode. In all other cases, you can safely say at the time of making payment or at the time of credit, whichever is earlier. Second point which you have to learn, now you have deducted the TDS, where to deposit, when to deposit, what is the time limit to deposit and how to deposit. When you have deducted the TDS, you have to deposit. In case of a government, in case the office of the government, if it is not without challan, if it is without challan, same day you have to deposit. But wait, in that case, the deductor has to inform the pay and account office, DDO, drawing and disbursing officer or other officer, who will in turn inform in 24G within 10 days. 24G form will be filled up within 10 days by the DDO or pay and accounts, and BIN number will be generated, book identification number. This is, and if the government deposit by way of challan, 7 days. In the case of TCS also, it is the same thing. But wait, for person other than government, for month of March, you have to deposit by 30th April. For the month of March, you have to deposit by 30th April. For April to February, you have to deposit within 7 days. Within 7 days. And where e-payment is necessary, company case and non-company whose accounts are liable to be audited under 44AB, e-payment. In other cases, you may do e-payment or challan, but 2 cases e-payment is necessary. And payment, I have told you what is the time limit. In case of a government, 7 days. Now, after the payment has been deposited, where to deposit? RBI, SBI, any authorized bank. After deposit, what you have to do? Quarterly statement. 24Q, 26Q, 27Q, 27EQ. What is the time limit for quarterly statement? For person other than government, it is 15 days, first 3 quarters, 15 days after the end of the each quarter. That is June, 15 July, September, 15th October, December, 15 January, but March, 15th May, 15th May, because the date of deposit is 30th April. But in case of government, it is different. In the case of government, it is the first quarter, 30th June, 31st July, second quarter, September, 31st October, third quarter, December, 31st January, fourth quarter, same, 15th May. This is, you have to file quarterly statement, and quarterly statement is a must by e-filing in the case of office of the government, in case of the company, in case of the non-company assessee whose accounts are liable to be audited, in case of those quarterly statement, if the number of deductee or collectee is 20 or more in any quarter, you have to file quarterly statement e-filing. Rest case is choice yours. But wait, you have to issue certificate also, 16 for Form 16 for salary along with Form 12BA by 31st of May, and for Form 16A 15 days after the quarterly return, that is for 15 July, 30th July, for 15th October, 30th October, for 15th January, 30th January, for 15th May, 30th May, for government 31st July, 15th August, 31st October, 15th November, 31st January, 15th of February, and for last 15th of 30th of May, form certificates to be issued. And in case of TCS, 27D is to be issued. And let me tell you, in quarterly statement, three things are more important than anything. Yes, in quarterly statement you have to give the TAN number of the deductor, PAN number of the deductor, PAN number of the deductee. But most important, which I want to tell you, SIN number and BIN number, all are important, SIN number and BIN number. But most important is detail of 197. That is those person for whom certificate has been obtained for the tax to be deducted either at nil rate or lower rate, or for those details of those persons who have submitted 15G and 15H, you have to give detail in quarterly statement of the name and address of those persons. And last, in the case of transporters who have provided you PAN number, you have to give the name and address and PAN number of those transporter in the quarterly return. In the quarterly, remember like this, and then the details in TDS. Advance tax you have to do, I am not denying that fact. Do the advance tax and interest also. It is clear. Now coming to appeal and revision, please concentrate more on 263 and 264 because that is more important. Mensiria and 263 revision are favorable to the revenue against the assessee, 264, and then 254 ITAT, that is more important. Then come to High Court, nobody bothers maybe, or even Supreme Court, nobody bothers. More important is this. Then come to penalties. You have to do, let me tell you, penalty of the default under respective section, not under this chapter. If there is a penalty for not filing a return, do it under 139. If there is a penalty for not getting the accounts audited, do it under 44AB. If there is a penalty for non-maintenance of account, do it under 44AA. If there is a penalty for international transaction like 271AA, 271BA, 271G, please do it under international transaction. Not do here. In penalty chapter, do only 271(1)(c). Concealment penalty with explanation, 7 explanation. Do 271AA(b) amendment, that search case, if you surrender at the time of search, before completion of search, 10% tax, undisclosed income. The penalty is 10% of the undisclosed income. If you surrender at the time of return, 20% of the undisclosed income, otherwise 30% of the undisclosed income. Earlier, if you surrender at the time of search, there was no penalty under section 271 AAA, but now it is different. For search conducted on or after 1/7/2012, 271AA(b). Do 275, time limit of completion of proceeding under penalty, do 275 here. Rest penalties you should do under respective chapter. Under respective chapter, not under this. Under respective chapter. Don't do this under this. Penalty under 221, do it under 220, do it under 140A. What is the penalty under 221? Assessee deemed to be in default, but not here. If there is a penalty for 269 SS default or 269 default called as penalty under 271D, 271E for not paying the account pay check, not receiving the deposit under account pay check, please do it under 271, 269 SS and 269T, and don't do it here. Otherwise you will be wasting your time. Don't put penalties everywhere. Lighter. Let the burden be lighter. Do the penalty under respective sections. Wherever the default is there, do penalty there. Only concealment penalty and search penalty should be done here. This is chapter on penalty. You can do the penalty chapter also. Search and seizure I have told you. Along with settlement commission, now coming to transfer pricing and specified domestic transaction. Because of, why specific domestic transaction? It is only because of 48(2), 80IA 8, 80IA 10, claiming deduction, inter-unit transfer or close connection or 48(2). In that case, specific domestic transaction. Remember, the aggregate value of the specific transaction should be more than 5 crore. Then only you are covered. Specific domestic transaction, new section which has been added for specific domestic transaction, transfer pricing provision also made applicable to specified domestic transaction. This is for 48(2), 80A, 80IA 8, 80IA 10, or under section 80IB, 80IC, 80ID, 80IE, you get that benefit of 80I 8 or 80I 10. That is specified domestic transaction. Please do that also, because that is a very important change in specified domestic transaction. Wait now. I am coming to now. I have given you what are the amendments, what you have to do. Coming to last point, wealth tax. 5 marks for practical. And don't think the practical will become for 12. There are 2 changes in wealth tax, remember. One change, that limit of 5 lakh house given to the director, whole-time director or whole-time employee or officer, which was earlier 5 lakh annual gross salary, now it is 10 lakh annual gross salary. If it does not exceed 10 lakh, then that house which is given to them will not be a part of wealth tax. And one, Reserve Bank of India income, wealth tax will be exempt. There's only 2 changes. But what I want to tell you, wealth tax practical is 5, and that will be relating to whether these are assets covered under wealth tax or not, or maybe valuation. The valuation important is only in one case, that is valuation of immovable property. Other valuation is market value, valuation of immovable property. So do valuation of immovable property, do what are the asset, what kind of asset included, what is the asset not included. But for wealth tax, also do assessment procedure. Please also do the penalty, appeal provision under wealth tax and settlement commission under wealth tax. Coming back, I know that it is only 25 days left. Otherwise, I would have told you how to do that. You should have prepared the notes. Now there is no chance of preparing the notes. I'm not denying. But whatever you study, if possible, have another friend. Both of you should discuss that points. Spare 1 hour. Spare 1 hour in the evening to discuss whatever you have studied in your income tax. Because you forget very fast. You forget. Now I can't tell you that do as many questions as you can, because there is hardly any time left. So do your RTP. Do your RTP of this year, and if possible of last year also, but doesn't matter. Do your practice manual, practical questions, practical question, practice manual, RTP, practice manual, and digest of the cases which are already there, and pick up some chartered, our journal. If there is any case which is not there in that, you will be able to do. But let me tell you, my dear, the direct tax is a difficult subject. I'm not denying, because there's so much of thing in direct tax. You may talk about so many circulars, so many notifications, so many cases decided, so many amendments taking place, so that you go mad about it, and they can ask anything. But if you ask me what is important, whatever you leave, that is important. Don't leave anything to the chances. Do everything. And let me explain. You have 15 minutes to read your paper. In the beginning, avoid reading the first question. because first question is always a difficult question and you get nervous very fast that I don't know anything. First read the other questions. Don't read the first question first. Read the balanced question which you have already with you and read those questions. Read those questions which have already with you. Read those questions. And then come to the first question. You will get nervous otherwise reading the first question is always difficult. But I am assuring you, it is not that difficult. First question contains certain case studies also. So it is, you are lucky that you have done last night, it is there in the morning. First thing I would say now, please believe in God. God is great. Don't cheat with the God. You can cheat with anybody, but you cannot cheat the God. Believe in Him and do your hard work. Leave it to the God. He is great. He is great person. Let me explain you, He is really great. Maybe you will become chartered accountant only when it is destined. And if the destiny is there, you will definitely. But there is no shortcut to hard work. There is no shortcut to hard work. It is said that God is not the sole author of your destiny. God is not the sole author of your destiny. You are the joint author of your destiny. You do best, He will do the rest. You do the best, He will do the rest. And if you rest, if you don't do anything, He will also rest. He will also rest. Do your best. Do your best and rest, leave it to Him. Rest, you leave it to Him. He is great. Believe in Him, whichever God you believe in. Do your hard work. Have from inside that don't get nervous at all. Tell Him you are great. Whatever, I will do my hard work. Rest is with you. Don't feel bad, don't have any tension. Avoid tension. Avoid tension. Don't get any nervous at all. Be cool. Be cool. How can you be cool when so much is to be done? Still you can be cool. Believe in God. Do your hard work. Leave it to Him. Leave it to Him. But don't compromise with your hard work. I'm assuring you, please don't compromise with your hard work. Do whatever best you can do, because the time is short. It is not that you have so much of time. If I had come to you about 3 months back, I would have talked in a different manner. But now it is not the time to talk to you or that. I'm again assuring you, please, I'm assuring you that please, you will get questions from recent amendment made by the Finance Act 2012. Expect 15 marks question, maybe even more, maybe sometimes 10 marks, but 10 is minimum, maybe even 20-25 marks. You can get the recent cases, recent amendments. Concentrate on that. Do practical question based on that. And then I'm telling you, whatever judgments, even if you don't remember the case, remember those are very important. Please, you have to do all Supreme Court judgment. High Court judgment where you find a new judgment has come. A new judgment. Don't do any tribunal judgment. It will never be asked. Don't do any tribunal judgment. It will never be asked. Only judgment of High Court which are new, or Supreme Court judgments which have recently come. Remember that it is very important. If the Supreme Court judgment has been overruled, don't waste your time on that. Vodafone judgment has been overruled. Why do you want to do Vodafone judgment at all when it has been overruled? You should know what was the idea of the Vodafone, but otherwise there is no need to do Vodafone judgment because it has been overruled. Again point, next point. Now you have a time to revise because you must have done revision 2 times, 3 times, 4 times. If you are alone, longhand, keep right points. When you have completed a particular thing, then for 10 minutes, 15 minutes, recall that by jot down the points which you have done in that. 1 point. Please concentrate on the points which are finer prints. Because general thing you remember, most of the time remember it is 2 years from the end of which date? Is it end of the financial year or end of from the date? So those points are finer points. Remember those points. Keep in mind those points. And I assure you, please, first you complete this way. TDS, advance tax or collection of recovery together. But don't do that first. First take topics which you have not done in your IPCC. Take a topic of first non-resident. Non-resident topic when you do, take a topic, first read double taxation. Why? Because treaty are based on double taxation avoidance agreement. Because of the concept of section 5, that income deemed to accrue or rise in India on because of source rule is taxable here, but because of residence rule it will be taxed in that country also. Double taxation. Read. Then how to tax the non-resident in India. Only 2 types of incomes of the non-resident are taxable in India. Incomes received in India, deemed to be received in India, accrue or rise in India, or deemed to accrue or rise in India. The most important is deemed to accrue or rise in India. Section 9(1). You cannot think of taxation of non-resident without understanding section 9(1). Then total income of a non-resident is taxable at 2 rates. One, everybody's income is taxable at 2 rates. Even my income is taxable at 2 rates. One is the slab rate or normal or special rate. Slab rate, in case of slab rate, individual HUS slab rate, otherwise company firm flat rate. So one is the normal rate. Normal rate are of 2 types, either slab rate or flat rate. The other is special rate. The special rates are given in chapter 12. Chapter 12, starting from 111A, 15%, 112, long-term capital gain, 20%. Sometimes long-term capital gain also taxable at 10% if it is listed share, listed sold through off-market, listed debentures and zero coupon bond listed or listed units. In that case, without indexation 10%, after indexation 20%. That point you have to do 112. Then special rates are given in 115A, non-resident, on money borrowed 20%. But remember 194LB, 194LC, that if it is debt fund, infrastructure debt fund, only 5%. If there is a specified company has been borrowing under an arrangement from outside India for certain period of time, it is 5%. Then 115A, subsection 1, clause B, royalty fee for technical services taxable at the rate of 10% if the agreement is entered into on or after 1st April 2005. Do it with 44DA, that if that person has a permanent establishment in India or a fixed place of profession in India, then 115A will not be applicable, then 44DA will be applicable. But if that person does not have a PE in India or does not have a fixed place of profession in India, then royalty and fee for technical services are taxable under 115A, subsection 1, clause B, 115A. Then do 115AB, offshore fund, long-term capital gain under 100 to offshore fund from unit is taxable under 10%. Then do 115AC, that is non-resident, GDR and notified debentures, income taxable at 10%, debenture taxable at 10%, GDR taxable, long-term capital gain 10%, 115AC, 115AD, foreign institutional investor, do it, that 30% for short-term capital gain, 20% for what you call in income, and 10% for long-term capital gain. Remember that, it is there in that case. Then 115 BBA, non-resident, non-citizen sports person and also foreign entertainer who was non-resident, not sports person, taxable at 20%. That is the special rate. There is a special rate for 115B also, lottery income, crossword puzzle. 115BB, lottery, crossword puzzle income, taxable at 30%. You know that also there is a case. So these are special rate. Then non-resident Indian, that is a special provision and special rate. 115C to 115I, investment income taxable at 20%, long-term capital gain from foreign exchange taxable at 10%. There are special provision, special rate. Then special provision relating to MAT, special provision relating to dividend distribution tax, special provision relating to income distribution tax, special provision relating to tonnage tax company. Those are special provisions. Tonnage tax company, do those special provision. And if there is a change in the venture capital undertaking also. Now venture capital fund and venture capital companies are investing in venture capital undertaking. Now this is a special purpose vehicle. I invest in there, I invest here in venture capital company and venture capital fund. They invest in venture capital undertaking. Now the money is received by this, but they are not taxed. Venture capital undertaking is not taxed. A venture capital company is not taxed. Venture capital undertaking is not taxed. I am taxed in the same manner as if I had made a direct investment. Instead of making a direct investment, ST section 115 OPQ for dividend distribution tax, do that. These are special provisions which are very important. Special provision starts from chapter 12 and they go up to chapter 12H. So do those chapters, do that chapters. Starting from 115A, going up to 115V, you have to do all those sections. It starts from special rate of tax, special provision relating to non-resident Indian, then special provision relating to the company relating to tonnage tax, MAT provision, then 115JC, AMT provision, then 115O to 115Q, dividend distribution tax, 115 RST, income distribution tax, 115U, venture capital, 115V, tonnage tax company. Do these provisions, do these special provisions. There are questions which can come from these special provisions. So, I have given you in a nutshell, not a nutshell, 2 hours, some amendments which were relevant and also the things which you are supposed to do. Still, you are most welcome to contact me on my email. If at all there is a query, you can send the email either to the institute or even to my email. But whenever you write an email, please write your telephone number also. I don't reply back on email because whenever I reply on email, I get another query, same on the same issue. If this happens, what will happen? If this happens, what will happen? So better if you write to the institute and they will forward those email to me. That will be better. But still, if you want my email, it is dr.girishahuja@gmail.com. But better it is come through the institute, it will be better because they will process it and then give it to me. So, I have given you what is the insight of direct tax, and don't think that everything can be done in this 20 days. You must have done quite a lot. Still, all the best to you. May God bless you, and I assure you, if you do these amendments, these recent cases, wealth tax separately, and of course Institute Tax Manual, you will get through this paper. All the best. Thank you very much. All the best. Thank you very much.